I'd like to talk for a little bit just simply about the detail of what bars are and the construction of bar charts. The simplest and most obvious representation of a series of prices struck within a market is the tick chart. These are actual bargains struck, successive bargains struck over time in a market. The bar is derived by taking a time interval and capturing the trades within that time interval and representing them by a bar. Typically, the most important aspect of a bar is to record the highest price within that time interval, be it 5 minutes, 1 hour, 1 day or 1 week, the lowest price, and that would be represented by a bar like that. At its simplest, that is a bar for a bar chart, of whatever time interval this might be. A derivation of that, in fact what I used to use in the 80s to represent Eurodollar futures in the CME, would be to represent it like this, with the closing level represented by a dot. A further development might be to represent it by a single line, with the opening level on this side and the closing level there. Under the influence of point and figure, I suggest, this now has become customary to represent this, the same thing, but giving it a colour according to whether the market closed higher than the open. If it closes higher than the open, it's green, and if it closes lower than the open, the whole bar is marked in red. That's definitely, it seems to me, under the influence of the current popularity of point and figure charts. What follows from this notion of these intervals is that there are different bar charts for the same market. If this is a 5-minute interval, you get a bar that starts there and finishes there. If it's a 5-week interval, you get the bar that starts there and finishes there as well. But if you think about your screens, which typically is what people look at, given a screen, there's only so much room, so that the 5-minute chart, an interval chart, might look like this. But the 5-week chart, or just say the weekly chart instead of the 5-minute chart, will have the 5-minute chart subsumed within one bar here, and might look quite differently. The reason for the fact that if you change the interval of the bar, the time interval of the bar, you get very different looking charts, is because these charts start from the present and work back historically, and with 5-minute bar charts, given so much room, you get a very different overall length of time going backwards. Those 5 minutes are maybe represented, say if this is an hour bar chart, say this is a daily bar chart and that's a weekly bar chart, this week would have this number of bars in it. The next week would have this number, but it goes back further. So one reason for the difference is simply that the historical time frame for the bottom of the chart is longer, the bigger the time interval used to make any individual bar. The other reason is, of course, that the longer the time interval, it hides the price action within it. A bar chart hides the price action of the 5-minute bar chart. The weekly chart hides the price action of the daily chart. So there are two effects by changing the time interval of the bar. One is to reveal more historically, the bigger the bar, and the second is to disguise the price action within the short-term price action within the longer-term bars. Those are very important distinctions, and the reason why we need to look, when we're studying any market with bar charts, you have to look at a multiplicity of different time frames for each bar. So, for example, depending on the sort of trader you are, you would look at the daily, weekly, monthly bar chart of the same market. Why? Because the monthly bar chart will reveal historical price action that you won't find on the day chart, and the day chart, because the monthly chart will be hiding important and interesting price action that you can only see in the day chart. Now we've understood that different representations of a market, of the same market, by changing the time frame of the bar, reveal very different patterns, you'll see the importance very clearly of not looking at any one time frame to understand a market. You cannot understand the US Treasury bond market by looking at a daily chart alone. You need to have a daily chart, a weekly chart, and possibly an hourly chart. The range of different time intervals you choose for your overall array of different bar charts of the same market depends on the sort of trader you are. Let's just go over this again. What I'm getting at is no more or less than this, that markets do this. Say, within this, you can have wobbles. So if this is the weekly chart, the daily chart would reveal wobbles around the weekly chart. And so that's the day chart. And within the day chart, of course, there'll be wobbles that you'll only find in the 5-minute chart. For that reason, you have to look at any one time to find out what are the forces, what's going on in the market at this level. You need to know what the 5-minute chart is doing, the weekly chart, and the daily chart. Let me just go over that again. It may be, for example, and we'll get on to patterns and trends in a second, but just speaking in general terms, it may be that there's a bear trend in a 5-minute chart, which is part of a bull trend in a day chart, which is part of a huge bear trend in the weekly chart. You need all those charts to understand what's going on. I started off by saying that bar charts were very simple and very accessible. They are. But once you grasp the notion that to understand any market, you need to look at it multiple time frames, it of course becomes very complicated. We'll go into the complexity in a second, but in terms of the practical need to marshal this information and represent it, one has to be realistic. It's most easily done using electronic systems. When you've got your electronic system, you'll find it very quick to spin between the 5-minute, the hourly, the daily, and the weekly and the monthly. So let me just go over that again. There's the 5-minute trend, there's the hourly trend, and there's the daily trend. Equally, that could be the daily trend, the weekly trend, and the monthly trend. These are all conflicting. The choice of time frame depends on the sort of trader you are. Basically, the more short-term the trader, the more short-term the time frames. But you need to look more than the time frame that you're trading in, because you need to know all the forces at work on your market at any one time. Everybody tends to specialize on a certain time frame, but no matter what your time frame, you still have to look shorter and longer to understand all the forces relevant to your market. If you're just a day trader, trading on a daily bar chart, you need to look at the weekly chart, and you should look at the hourly chart too. The hourly chart will help you finesse and get the optimum entry levels inside when you're trading the day, and the weekly chart will tell you the forces at work on your day chart. We'll come back to this.